Hi guys, it's your favourite YouTuber again, Dami Solari, and you're watching DS Learning Finance. Whoa!
I wonder what
and
stop loss is.
Where is that sound coming from? Well, anyway, I've got viewers here to speak to, and that's you guys, and I'm going to tell you why you need a stop loss, people. Why you need a stop loss. As the name suggests, it's actually a safety precaution to stop losses.
Gee, I couldn't have guessed.
Nah, for real, nah, this thing is rude. Whoever you are, you're so rude. Anyway.
How does it do that, Danny?
Seriously, where is it coming from? But anyways, it's an instruction you basically give to your broker before or during the acquisition of a share that you're looking to invest in. So it's a minimum amount you tell your broker you're willing to sell your shares for before it actually gets to that price and before it plummets down even further.
Say what?
Okay, I don't even care anymore. In layman terms, it basically stops you losing more money than you're willing to accept. On the other side, it can ensure that you sell your shares and make a decent amount of profit before the price falls and basically eats into your profit, which you definitely don't want. This is called top slicing. So a stop loss can sell your shares when you're making a good chunky profit and before the price goes back down again. My one and only rule: always have a plan of action, i.e. a stop loss plan before you invest. Always. By default, a stop loss of 50% lower than the price you bought that stock for should be set before you even think about buying that stock. The stock market fluctuates heavily like everything in life, but more often than not, the number of companies that have their share price decrease by 15% compared to what an investor originally bought it for, those companies just keep on plummeting. So if you bought a share for £10 and then the price eventually went down to £8.50, those stocks that do that, they'll just keep on decreasing. So yeah, the companies that do that, you definitely want to pack your bags and leave. So don't fall for that. Plus, if you guys are doing your research like I know you guys should be doing, you'll never invest in a company that's so volatile. So yeah, just don't invest in volatile companies, guys, unless you're willing to take the risk and have done your thorough, emphasis on the thorough, research. And another reason why you need such a tight stop loss is because as soon as you buy any share, you're automatically at a loss compared to selling it. So the buying price will always be higher than the selling price. So you ultimately got that spread to accommodate for. Therefore, you need to make sure that you're not going to lose more money than you need to, and that stop loss comes in. Hence, you've got another obstacle to climb over, and this means you've just got to work extra harder to make sure that you make money from your investments, to make sure that you're successful. Now, notice how I said 85% is the default. Now, this doesn't mean it is your be-all, end-all, sort of written and engraved in stone stop loss. No. It just means that this is the standard upon which you can adjust it from accordingly. So if you've got a very volatile company that you want to invest in and you think it's going to be a very risky investment, then you may want to apply a tighter stop loss, i.e. 90%. So you will just lose 10% of your original money as opposed to the original default 85%. You may want to make your stop loss tighter. On the flip side, if you've got a company that you know will be steady progression, growth, you may want to make your stop loss a bit looser because you know that it's going to be a progressive growth in that company. And maybe it's had a pitfall and that's why the share price has gone down lower than what you've expected. But to be honest, like I said, when you have the share price that goes down by more than 15% of your original amount, then it's starting to become a big issue. Fair enough, you might have done the research, you might have done thorough research, but at the end of the day, that is past history, and what matters the most is what's going on now. So that company could have been brilliant in the past, but they could be breaking so many legislations, they could be doing the wrong things right now, and ultimately that will tarnish their image, their legacy that they've laid in the past. So I would say 85% is the lowest you will go in terms of retaining your amount, retaining the money that you spent. You want to keep at least 85% of your money, if not more. With volatile companies, make it tighter because you can't tolerate less. Now,
surely this is too good to be true.
Well, actually, yeah, there are two disadvantages. One is that you're not always gonna sell out when that share price hits 85%, because maybe the share price is falling so quickly for a particular stock that it's just physically impossible to sell that stock at 85% of the price you originally bought it. So the price goes straight from 10 to 7 all at once like that. So sometimes you may put so much effort into setting a stop loss, but the share price, when it goes down, it may not actually even hit that ever. So yeah, like, don't rely heavily on stop losses. They're not 100% proven to work. Problem number 2 is be wary of how you set your stop loss with particular companies. Now, some companies have massive spreads, particularly companies in the FTSE 350 or the FTSE fledgling or the A market as well. Those 3 markets, you've got to be wary of spreads because they can really affect your stop loss that you've set. So a classic example is in the morning you have spreads which are massive. Spreads can be 10 to 20% of the share price. So if you set your stop loss at 5% of what you originally bought it for, and the spread that day is 15% difference, then guess what? You're gonna sell your stock without you even knowing that you did. And the bitter part is you didn't even want to sell it, but yet you were forced to sell it because you set that stop loss. So you've got to really keep an eye on your stop losses and make sure that your stop losses don't cross over with drastically changing spreads. And the thing is, it can be like that before the stock market even opens, and then once the stock market opens and give it a few hours, things go back to normal again. The spreads start tightening up, and then you're just thinking, oh my gosh, I accidentally sold all my shares, even though that wasn't really the true reflection of how the market is. And you end up basically regretting that decision. So yeah, don't accidentally get out of a bid by setting your stop loss too low, especially for really fluctuating, drastically changing share prices, because it will just simply miss it. Let me give you some solutions for this. 1, always keep a vigilant eye on your stop losses and the stocks that you're investing in, obviously. 2, if your broker allows for a moving stop loss, always go for that. A moving stop loss adjusts according to whether you're making a profit or whether you're making a deficit. It will adjust automatically according to the percentage that you initially agreed on. So like I said, if it's gone up to £12.50, because I've got a moving stop loss, I no longer have to physically change my stop loss. Instead, the stop loss will automatically increase to £10.20, which is still that 85% of that £12. So yeah, moving stop losses are sick. And solution number 3, which is just as good as a moving stop loss, is establishing a range of stop losses. So not just having 85%, why not have 90 down to 85%? So yes, that share price can initially skip that £9, but because you've got that £8.50 range to operate within, you're still going to sell your share at £8.50. You're not going to lose as much as you could have if it completely just passed all those stop losses. Having a stop loss range is so useful because it allows you to establish a range in which you're willing to accept selling your shares for. And when you have a stop loss range and a moving stop loss, it's just the best of both worlds, guys. Best of both worlds. That's the only way I can put it. All in all, stop losses are good safety precaution, but with a capital B. Yeah, they're not 100% proving to work. They don't always 100% occur. They don't always 100% kick in. And like I said, with those reasons, with those disadvantages before, you don't want to rely on them all the time because ultimately it's your money. And if you've got brands in a particular stock, then you don't want to have to rely on a stop loss that doesn't work sometimes and then works others. So you need to really caution, be vigilant of what's going on with your stocks. And if you're ever thinking, okay, I know that this stock is a good investment because I've done the research, even though the share price has gone down, decreased by like 50%, I know this stock is good, I know it's good. Yes, it may be a good stock, but just because it's going down a spiral staircase doesn't mean you need to be along the ride while it goes down. If you feel it's going to come back up again, then simply exit at the 85% and come back in at the 50% when it's hit rock bottom, and then keep that stock and then make profit from it. You can still make profit coming in at half the original price of what you saw it. It just means you don't have to suffer. Pack your bags and go, like my mum likes to say. I hope you guys like this video. I hope you love my channel, guys, and you know what to do. Keep watching. Why? Because I'm too consistent.
Just get it over and done with.
Why are you still here? But yeah, anyway, don't forget to like, subscribe.
Bye.
Yeah, anyway, don't forget to like, subscribe and share. DS Lennon Finance. Whoa. Bye.